What's ahead for Bay Area real estate in 2025? I'm Brett Jennings with Real Estate Experts, and we're going to talk about that and more in our winter market update and forecast. So the question we are always getting here is, how is the market? Well, to answer that in simple terms, we'd like to say this market continues to be steady in spite of higher interest rates. We know that rates shot up in 2022, and that significantly slowed down the market. But the good news is in 2024, sellers are coming back to the market, but not in droves. In 2024, we saw a 15% increase in the number of sellers coming back to market, and that is significant considering that we saw almost a 40% drop in the number of sellers after interest rates shot up in 2022. We are seeing a good amount of sellers coming back, but it still hasn't come back to what the number of sales were prior to the raise in interest rates. As far as 2025, we are expecting to see potentially about 11% more sellers coming to market as those people who finally decide, you know what, rates are not going to be coming down, back down to the 5s or the 4s. So if we're going to move, we might as well just move now. Now, let's set the bigger picture when we talk about the broader market. This is looking at the last 40 years of Bay Area real estate. And we affectionately call our market the Garden of Eden of real estate because here in Silicon Valley and the Bay Area, we enjoy 2 times the national average of price appreciation. In fact, this nice, long, consistent run-up averages 7.66% per year over the last 40 years. And when we open this conversation by saying our market is steady, that's because where are we today? Well, we saw prices increase in San Mateo County, not quite the 7.6, but still very good at 6.3%. We saw prices increase in Santa Clara County, 6.9% year over year, which is close to our 7.66% national average. What's driving these prices and fueling the market? Well, to keep things simple, we like to say real estate is a supply and demand driven market tempered by interest rates and the stock market. So what's happening with supply? Well, we have persistently low supply. If we look at this graph here, shows the last 5 years of inventory. The kind of roller coastering that you see going up and down is what we call seasonality. That is, there's a lot more homes that come for sale in the summer months, and that inventory dwindles down as we approach the end of the year. The red line I drew here at the bottom of the graph is showing that where inventory bottoms out at the end of each year, and you can see it's progressively getting lower and lower. In fact, when the clock struck midnight on New Year's Eve here in Silicon Valley, we had only 312 homes for sale, and that's for a city of over 1 million people. Not a lot of inventory. So even though sellers are coming back, we are still short on homes. This is a quote from Mike Simonson of Altos Research. He says, 2025 is poised to continue the trend of rising inventory across the country. We'll probably finish 2025 with 15% more homes available than we have now. Realtor.com's forecast is for 11%. Our local market forecast agency here is saying we might see as much as 15% more homes coming to market this year. But we also have increasing buyer demand. This is a graph showing foot traffic over the last 12 months. And as you can see, foot traffic at open houses steadily increased in 2024. More and more buyers coming through open houses. Another interesting stat that we look at is we break the market out into 4 quarters or quartiles. This is looking at price segments in Santa Clara County. Our median home price in Santa Clara County is just under $2 million. But what's interesting is when we take a look at each section, believe it or not, our fastest moving segment of the market is the high end. The top price tier in Silicon Valley is $5 million. And just this last week, we had 19 new homes come to the market in that $5 million price tier. However, 25 sold. Now, some of you might be asking, wait a second, how are we able to sell 25 homes when only 19 came to the market? Well, as we started this conversation, I told you there were about 300 homes for sale at the beginning of this year. If we break that into 4 quarters, it means we have about 75 homes in each tier. 19 additional homes came to the market in the top tier, but 25 sold. So that's pretty interesting that we have our $5 million price tier is the most active in the market. The next most active tier is just below the median home price at the $1.6 million tier. Last week, we had 34 of those homes come to the market and 31 sold. So those homes are getting snapped up just about as fast as they are coming to the market. So what's driving this home buying interest this winter? Well, we still have a strong job market, and that always provides a good foundation for housing. Although you may have been hearing some rumblings about some layoffs happening at Facebook or Meta and other places around Silicon Valley, a lot of that is sector rotation. And overall unemployment is still very low in Silicon Valley at 3.7%. That's compared to what it was in 2008. It got as high as 8.3. In fact, this is looking at the Bay Area unemployment going all the way back to the year 2000, so almost 25 years. And we can see that the unemployment rate currently is at 3.7% compared to 3.8% last month and 3.6% last year. Although it's slightly higher than last year, it's far lower than the national average of 5.7% here in Silicon Valley. And one of the things that I know when I took a look at the unemployment data, comparing it to price movement, it takes unemployment getting up to about 7% before it has any impact on home prices in the Bay Area. So we're in good shape there. Here's a quote from the Times-Herald that Bay Area, California adds jobs at a modest pace. So jobs are still being added in California. The stock market. What's happening with the stock market is, we said, real estate is supply and demand driven, tempered by interest rates in the stock market. 62% of the value of the NASDAQ is here in Silicon Valley. And last year was a great year. The NASDAQ is up 31% year over year. So a lot of those companies with high flying stocks put plenty of money in the pockets of these home buyers that cash in their employee stock purchases for down payments on these homes. What is the next tech boom? Tech boom, every tech boom we've had, from semiconductors to the personal computer to the iPhone to social media, has fueled another wave of big companies going public, giving the whole Silicon Valley a flood of new liquidity and driving prices up. What's our next tech boom? AI. As we know, NVIDIA has been quite a high-flying stock, but outside of NVIDIA, there are a lot of other generative AI companies hard at work. In fact, this is a quote saying that city officials in San Jose say it's home to the largest number of AI patents filed in the nation, with almost 9,800 patents filed at the Silicon Valley U.S. Patent and Trademark Office in San Jose. In addition, AI companies overall experienced a 14% funding decline, but companies working on generative AI saw a 220% increase in venture capital, going from 4.1 billion invested to 9.4 billion invested. So what can we expect? The stock market, if it continues to rise, will drive our real estate market. And if we see continued growth in AI stocks, expect that to affect prices in a positive way. What's happening with interest rates? Well, as we know, interest rates have been pretty high. Rates were abnormally low for the better part of 15 years, and they've been abnormally high for the last 2. They are coming down, but where they'll settle out is going to be a level that's higher than what we'd seen before 2022. And that's from Greg McBride. He's a chief analyst at bankrate.com. This is just an interesting thing to kind of benchmark where we can say rates have normally been. This is going back 50 years, looking at interest rates and seeing what the average interest rate was by decade. In the 70s, it was close to 9%. In the 80s, it was almost 13%. In the 90s, it was just over 8%. In the 2000s, it was 6.25%. And in this last decade, it was down at 4.09. And I think most people in the mortgage industry would say that is artificially low. Our average over the last 50 years was 6.91, which is not far off from the very close to 7% we are right now. So where are rates headed? Well, waiting for lower rates is not guaranteed. Over time, you will see prospective home buyers just start throwing in the towel, because these rates are not going to come back down to the 4s and the 5s that we've seen in years past, certainly not anytime soon. Here is what the analysts are saying for the forecast on our 30-year fixed mortgage rates. This is 9 different forecasters as of January 2025, and they're all above 6%. In fact, most of them, I think, are going to be right around between 6 and 6.5. We're obviously not there right now. Rates are closer to 7, but we do forecast by springtime, rates should drift down if our economy doesn't get too hot. So our 2025 housing market forecast, rates will rule the market. Where will rates be and how will they affect the market? Well, here's a simple rule of thumb. If rates are under 7%, prices will rise. How low they go below 7% will determine how fast they rise. If rates stay right around 7%, you can expect prices to be relatively flat. And if rates go up to 7.25 or above, expect prices to turn down, to soften and actually come down a little bit. So here's our forecast for winter. Rates will slowly decline as inflation comes back down. Demand is going to increase as buyers come back into the market, especially after Super Bowl Sunday. Supply will improve as sellers are coming back to the market. Remember, we talked about at the opening of this session that we might see as much as 11 to 15% more sellers this year. However, there is plenty of buyers there to purchase those homes, and we feel that prices will probably rise 3 to 4% this winter into the spring as demand exceeds supply. So what does this mean for you? We have a saying in the business, and we say, buy like it's 1995. You've heard the saying, party like it's 1999. We're telling you, buy like it's 1995. Why? In 1995, we just came off a 3-year recession where we had really high interest rates. Interest rates got up as high as 9% in 1991, and they came down gradually down to about 7%. After that, we had a nice 7-year run up where prices rose 100% in 7 years, and we're in a very similar position. We've got interest rates that have been up in the 8s coming back down closer to 6, and we have a nice, what looks like run way ahead of us with an administration that's favorable to real estate and a stock market that's doing well. If you have any questions about the real estate market or what to do, please feel free to reach out to the person who shared this video with you. And until we talk again, this is Brett Jennings saying we'll be right here ready to help you create a better life through real estate. Have a great one.